Well, good morning. I'm Michelle Sakirka, President and CEO of the New Jersey Business and Industry Association. It is my pleasure to welcome you this morning for a briefing on the One Big Beautiful Bill, what it will do and what it will mean for New Jersey. First, I'd like to thank our sponsors for this morning: Association Member Trust, Citizens, Focus New Jersey, Manufacturing Counts, Minding Your Business, New Jersey Business, and Planet New Jersey. We're very excited this morning to bring this briefing to you. It's been quite a flurry over the last 6 months. A lot of information being offered to us each and every day. Kind of feel like you feel and drinking like from the fire hydrant each and every day. And today we're going to try and bring some clarity with our great partners from K&L Gates. Just want to do a shout out to our own Deputy Chief of Government Affairs, Ray Cantor, for helping to put this program together today. With that, I'm going to turn it over to an amazing and very talented lawyer who's going to lead the discussion today from K&L Gates, Rebecca Mulfried. Rebecca, it's all yours.
Much, Michelle, and thank you, NJBIA, and especially to Ray Cantor, as Michelle mentioned, for inviting us all here today. I am Rebecca Malfried. I'm a partner at K&L Gates here in our Newark, New Jersey office, and I am thrilled to welcome a group of my colleagues from DC here today to join us to set some clarity with respect to the One Big Beautiful Bill Act. Also point out, to the extent that there are still open questions, just a little bit of housekeeping before we kick everything off. Our plan today is to have each speaker talk for about 10 minutes on different aspects of the law. And during that time, if you have questions that are relevant to what's being discussed, feel free to drop them in the chat. I will be monitoring that, and I'll pose those questions to each speaker, provided time permits and the questions relevant to the particular topic at hand. And then after that, we're going to move into a moderated Q&A with each of the speakers, where we will also continue to monitor the chat so that we're sure to answer your questions. While each person is speaking, I'll also be sure to drop their contact info in the chat. If you have questions for them after the program, any of us would certainly be happy to connect. So with that, I'm going to turn the program over to our first speaker, Ryan Carney. Ryan is a government affairs counselor in our DC office and our public policy and law group. And Ryan has the job this morning of setting the stage about the One Big Beautiful Bill Act and give you some high-level observations. So Ryan, the floor is yours.
Great. Thank you, Rebecca, and it's great to be with everyone virtually today. So as Rebecca said, I want to kind of set the stage as to what happened, why did it happen. The most important thing is there was a Washington, D.C. And Congress in particular sometimes result in what you might consider kind of least common denominator governing, which is passing things that absolutely need to be passed. So government funding, programs that are expiring, and kind of new initiatives are rarely advanced unless they are in big legislative vehicles. So there was a real political imperative for the Trump administration and for the Republican majority in the House and the Senate to pass a big tax bill. In 2017, the Tax Cut and Jobs Act, signed by President Trump in his first term, had a lot of the individual provisions for individual taxpayers expire at the end of 2025. So unless the Republicans wanted to be on the hook for some north of 90% of Americans getting a tax increase going into the midterms next year, they had a real political imperative to pass something. Then what I want to do is set the stage though in terms of the vehicle that they used. Budget reconciliation is a type of legislative vehicle that prevents filibuster in the Senate. And since no party has had 60 votes in the Senate for 15, 20 years or so, it makes 51 the magic number in the Senate. And so when one party has a trifecta of the House, the Senate, and the presidency, they, over the past quarter century, have used the budget reconciliation vehicle with increasing fashion. So much of the Affordable Care Act in 2010 was passed using this vehicle. The 2017 tax cuts that President Trump signed, the American Rescue Plan, Biden's stimulus, and then President Biden's Inflation Reduction Act, a lot of the green energy provisions, all were used in basically a partisan exercise because their party had the House and the Senate and control of the White House. So it was not surprising that after the election results, the Republicans chose this option as a way to extend the tax cuts. Had the Democrats won the House, or had the Democrats maintained the Senate, it is likely that there would have been a bipartisan plan to extend tax cuts, which would have looked very different from the one big beautiful bill. But it is unlikely that nothing would have happened, that the Democrats would very much not want to be on the hook voting against tax increases or voting against a bill that would prevent the tax increases if indeed they could kill it because they controlled one body. If you watch the news or read online, you would think this is the messiest bunch of palace intrigue ever. There's all sorts of rumors about what's in, what's out. There's all sorts of hurt feelings between members of the majority. There's all sorts of contradictions. One day it's we're going to focus on this policy. The next it's almost the policy in reverse. And the minority party is basically shut out again, with 51 being needed in the Senate. Really only 50 because the president's party, the vice president can break the tie. So 50 votes plus the vice president is kind of the magic number. All sorts of rumors back and forth about what was going to be in this bill and how controversial it is, how the American people don't, like the provisions that are in it. I would argue that if the American people really didn't like most of the provisions in it, the Democrats would have undone it when they had the opportunity. So in 2021 and 2022, when President Biden used his budget reconciliation vehicle for his priorities, they chose not to get rid of the Tax Cut and Jobs Act provisions affecting individual taxpayers to pay for the green energy credits and some of the stimulus funding. The fact of the matter is that the tax cuts on average Americans are overwhelmingly popular by independent voters. So I don't think it was as controversial. I think that the saga that took 6 months with kind of an artificial deadline of get me this bill by the 4th of July added to the intrigue. But I don't think there was ever a scenario where Republicans were not going to pass a big tax bill this calendar year. So where does that leave us? Very big picture, and all of my colleagues will dig into some of the little nuggets in the bill. But big picture, this is a Republican bill. For the entire saga that got us here over 6 months, what we ended up with is keeping taxes lower on roughly 92% of Americans. It's good for business in some of the provisions, the R&D, the immediate expensing, some of the things that were made permanent. There was good stuff for kind of new Republican voters, as the Republican Party has moved from Chamber of Commerce, Wall Street, white-collar voters in the suburbs to blue-collar. We see things like no tax on tips, no tax on overtime, essentially no tax on Social Security income with a additional standard deduction for seniors. And it was paid for primarily by reforms to Medicaid and repealing some green and clean energy tax incentives. So if I were to tell you at the beginning of the year, Republicans are going to keep taxes low on individuals, they're going to reward new voters with the no tax on tips, no tax on overtime. They're going to work with business on expensing and R&D, and they're going to pay for it by getting rid of some Biden-era green energy and provisions and some reforms to entitlements. You'd say that seems like a pretty boilerplate Republican bill. President Trump has ushered in kind of a newer Republican Party, but the provisions that I laid out right there are pretty traditional. In terms of the reforms to Medicaid, that seems to be where the Democrats have decided to attack the bill, which is unsurprising. But although the American people do not like cuts to Medicaid in a vacuum, some of the provisions that are being reformed in Medicaid are overwhelmingly popular, like work requirements for able-bodied childless adults, like illegal immigrants not getting access to Medicaid, et cetera. So we will see next year on election day how popular or unpopular the bill is. But in terms of something that is like a consequential sea change, I don't see it that much. The Affordable Care Act was a consequential sea change in American public policy, which used budget reconciliation. Tax Cut and Jobs Act changed tax rates and the way in which we tax businesses for years was consequential. This is extending the current tax rates as is with reforms to the Inflation Reduction Act. Again, not surprising. And one of the things that we see in Washington often is when something has a partisan only solution, when the other party comes into power, that's generally first on the chopping block. 0 Republicans voted for the Inflation Reduction Act, which created a lot of the green energy credits. And so Republicans, although they may like some of the provisions, were willing to go after them to create the revenue for this bill. Whereas many Republicans, though in the minority in Biden's term, voted for the infrastructure bill. That was never considered a pay for this legislation because there was buy-in. So if you want durability in public policy and less of a seesaw effect, you need bipartisanship. And what's unfortunate is that the most consequential pieces of legislation over the past quarter century have come with partisan majorities and without true bipartisanship. I'll say one final thing is that to his base, President Trump not only delivered the no tax on tips and no tax on overtime, much like we saw with President Biden, the fact that the president was able to pass something of consequence, a big, beautiful bill, is kind of a return on investment and showing that he is delivering. The same way a lot of voters said that President Biden was effective, even if they didn't necessarily know some of the provisions in his legislation because he was passing big legislation. So there was an ROI to Trump's voters. There was special focus towards his kind of newer Republican voters, the blue collar, less less income demographics, keeping taxes as is, which is lower than they had been on individuals, some of the pro-business elements, and paying for it with things that Republicans have routinely said that they don't like and would want to go after anyway. Again, there was a lot of drama to get here, but when we look at the finished product, it is a pretty boilerplate Republican orthodoxy. So I'll pause there.
Thanks so much, Ryan. I don't see any questions in the chat, but one question that I do have for you, before we move on to the other speakers, is you talked about the fact that this really isn't a consequential sea change, and it's sort of, we've seen whether it was President Biden, now with President Trump, sort of this move away from a bipartisan era. So I'm just curious. I mean, I know our firm is a bipartisan firm, NJBIA is a bipartisan organization. New Jersey tends to be, I think, a little bit more of a purple state in that from a lot of what I also hear, you have conflict potentially between the two parties. We tend to be a little bit more collaborative, with respect to our legislation. So do you see potentially like an era where we're going to move back to a bipartisan time? Or do you think and I know it's hard to predict, but we're going to keep seesawing with pushing this partisan agenda, that one, and even if it's not the consequential sea change, still having all the drama and kind of the elevated, I guess, feelings around it?
I do. I think that for one thing, I mean, the Republican majority in the House is 220 to 215. So if the Democrats were to have won 3 contested seats last year, they would have had the majority, in which case budget reconciliation, a partisan exercise, would not have been available to the Republicans. And so because of the need to prevent taxes from going up next year, there would have necessarily been a bipartisan compromise. And I also think that when we watch cable news or go on X, it's conflict and sells. there's plenty of issues right now that have bipartisan buy-in terms of both parties agree where they want to go, same direction, but how to get there is where the compromise is. And I'm thinking about this week, it's cryptocurrency, where a not insignificant number of Democrats are voting with Republicans. China, there's been a sea change of kind of the previous bipartisanship, exemplified by George W. Bush and Bill Clinton, to now much more confrontational towards China and the challenges that China presents, that both Republicans and Democrats address. Infrastructure is another one, as I mentioned. So there are plenty of issues where Republicans and Democrats will come together. We often see at the end of the year, the National Defense Authorization Act is a bill that reauthorizes the military. It has passed every year for 60-something years, and it passes with broad bipartisan support. Oftentimes, the only people that don't vote for it are the kind of fringes on both sides, and just about everybody else will vote for the NDAA. So although conflict sells, there's plenty of areas of bipartisanship that is something that maybe isn't as reported, but big consequential things.
Thank you so much. So now that Ryan has provided an overview, I'm going to turn the program over to Mary Baker and David Skillman. I believe Mary is going to talk first. I don't know, Mary and David, if you're going to chime in at any point together, but Mary is a government affairs counselor in our DC office. She's part of our public policy and law group, and David is a partner in our public policy and law group. And Mary and David have the challenging, yet they do it in an ever so understandable and relatable way of breaking down some of the tax provisions in the One Big Beautiful Bill. So Mary and David, the floor is yours.
Well, thank you, Rebecca, and good morning, everybody. Thanks for joining us. I'm going to be talking about the more business-focused incentives. David is going to be talking about what happened with energy incentives in the bill. So there are a lot of business-related provisions in the bill that I'm going to be kind of going through a laundry list. And as you have questions, please feel free to post them in the chat. But I want to at least give you a general familiarity of the things that are in the bill that could affect your businesses. As Ryan talked about, this bill it's generally, the focus is very business favorable. It's also very US centric. It's focused on incentivizing US manufacturing, US supply chains, US jobs, economic stimulus in the United States, and also addressing the trade balance, which has been a priority for the Trump administration. So on some of the Tax Cuts and Jobs Act in 2017, you will recall that there were certain provisions that were in there very business friendly, stimulus friendly, that were temporary. And so there was a lot of back and forth in this bill, but ultimately many of those provisions were made permanent in this bill, including 100% full expensing for personal property that's used in businesses. That is effective for any property that's acquired after January 19, 2025. And you might say, well, why that weird date? You may recall that the president in his January or whenever that was, the kind of the State of the Union address that wasn't called the State of the Union address, said that he wanted to make full expensing permanent as of the date that he was inaugurated. He was inaugurated on January 20. So that's what's behind that date. We've been told by Treasury that they intend to interpret that in a similar way, although the language is not exactly the same as it was in the Tax Cuts and Jobs Act, that they intend to interpret it in terms of scope and binding contracts and things like that, the same way that they did with the Tax Cuts and Jobs Act. It also makes expensing of research and experimental expenses permanent. That in 2022, that began to have to be amortized over 5 years. So beginning this year, that the R&E expenses are now totally deductible in the year that they're incurred. And then on the interest expense, again, in 2022, that was scaled back. The base against your allowable interest expense deduction was scaled back to EBIT. and that has been restored to EBITDA, and that is now permanent as well. The Section 199A pass-through deduction was also made permanent. At one point, it was bumped up a percentage that came back down because budget reconciliation is a numbers game. So it's like whack-a-mole. If you do something here, you may have to adjust something there, but it was made permanent. There was a new provision in this bill, full expensing for certain production facilities. These are facilities that are used for production, for chemical agriculture products, also manufacturing, and also mining. So it's the actual building. So if you begin construction again after January 19 of 25 and before January 1 of 2029, and then you place the facility in service before 2031, you can deduct the entire cost of that production facility less the office G&A type space, but the actual production space is the cost of that is fully deductible. You may recall that if you have semiconductor facilities manufacturing, the new Section 48D that was passed a few years ago, that also allowed for the deductibility of semiconductor facilities. That rate was raised for just the 1 year that's still in place from 25% to 35%. Qualified small business stock was greatly enriched. It is now, if you hold your small business stock for 5 years, you can exclude 100% of that. That cap was increased the exclusion was increased to 15 million. And then the gross asset value of the capital assets was increased to 75 million. And then it reduced the holding periods to get a 50% exclusion and a 75% exclusion to 3 years and 4 years, respectively. For smaller businesses, it increases the Section 179 threshold of deductibility to 2.5 million. For those of you who have to file issued 1099s, it finally increased the threshold from the old $600, it's been there forever, greatly outdated threshold to $2,000. For those of you who have to file the dreaded 1099K garage sale information reporting, it restored that back to the prior levels of 200 transactions and $20,000 worth of business. So that was, I actually worked on that when I was on the Hill working. I managed that information reporting proposal. As Ryan mentioned, it does include no taxes on tips and no taxes on overtime. So as employers, I know that there are a lot of questions about how does that work for the withholding tables and exactly which tips qualify. For the tips, it's also, they have to be voluntarily given. So what does that do with your service charges that you might add to a restaurant receipt for larger parties? There's going to be a lot of questions. The IRS has announced that they intend to issue transition guidance on that. And they did issue just sort of a brief primer on their website a couple of days ago, but there are going to be legitimate questions about the implementation, which we just don't know the answers yet. The bill permanently limits the excess business loss deduction for pass-throughs to $500,000 for married filing joint returns. The business meals deduction, like snacks in the office, meals for employees, is generally repealed. There are a couple of exceptions, and entertainment meals still stay in place, but the employee meals is being repealed. For those of you who give charitable deductions for corporations, there is now a 1% floor of taxable income. So you need to exceed your 1% of your taxable income before you can begin to deduct your charitable donations. If you are involved in the housing, affordable housing, it made the low-income housing tax credit permanent, made some changes. It also made the new markets tax credit permanent, made some changes. Similarly, if you remember the opportunity zones in the 2017 Tax Cuts and Jobs Act, it made opportunity zones, this bill made opportunity zones permanent with some tweaks. including some information reporting, which there'd been a lot of criticism about the Oz program and the lack of transparency. It also includes incentives particularly focused on development for rural properties and rural communities. So as the stock market is now doing well, as real estate prices rebound, we're going to see more capital gains, and I think we're going to see a resurgence in the interest of opportunity zones. There were also a number of what I call technical stuff that's included in this bill, like the disguised sale rules for partnerships is now self-executing, and it's not waiting for IRS guidance. And then on the international front, there are a number of technical things, like it repealed the downward attribution rules in 958b4, if that means anything to you. It also made the controlled foreign corporation look-through rule permanent, which has been a perennial extender. Things that are not in this bill, they did not address WOTC. WOTC is scheduled to expire at the end of this year, so that is a temporary tax provision that could, as Ryan was talking about, be a motivator for some bipartisan legislation. It didn't repeal the stock buyback tax, but it didn't increase it either. It made some tweaks to the corporate alternative minimum tax, particularly for oil and gas, but it did not repeal that. That's not a particularly popular tax, as you know. On the international front, the big headline is that there's no revenge tax on foreign corporations and foreign persons that have US income. That was pulled from the bill as the G7 came to an agreement to try to agree on making the US compliant with international tax rules, particularly the 15% minimum tax. It changed the GILTI and FDII deductions. Their effective tax rates were increased. They are now 14%, and that is a permanent rate. For the GILTI and for both deductions, it took away the deduction against your capital assets. You could take your CFC income, reduce it by a percentage of your capital assets, and that was going to be your GILTI and FDII income. It took away that deduction. It did increase the offset for foreign tax credit to 90% from the current 80%. And then for the base erosion anti-avoidance tax, the BEAT tax, it raised the rate to 10.5%. Again, that's permanent. So those are for individuals, the estate tax exemption is now permanently 15 million to be annually adjusted for inflation. The SALT cap, 40,000 cap, temporary with income phase out. So that is going to be beneficial for a lot of taxpayers, which I thought was worth noting. And then the last thing that I will just say is that there's going to be a lot of guidance on this. There's going to be IRS notices, probably, maybe revenue rulings, revenue procedures, and then there's also going to be regulatory projects. So these are things all to be paying attention to. And I just cannot stress enough that even as a smaller business, and particularly as the larger group organization, you can have a real impact on the shape of what regulatory projects look like. So keep an eye out to when those projects open up to be sure to weigh in with Treasury to provide your input to help shape that process. And now I will hand it over to David to talk about energy.
Well, thanks, Mary. That's as you can all tell, there are a lot of different provisions here. So Mary sort of raced through a lot of these business-related tax changes. Tons of detail there. So don't hesitate to reach out. I think our emails are in the chat, and obviously Rebecca knows where to find us. I'm David Skillman. I'm a partner in our public policy and law practice. I spent a long time on Capitol Hill working with the Ways and Means Committee, alongside New Jersey's finest, Mr. Bill Pascrell, who we miss, and his fabulous team. In that role, I was primarily doing tax policy, including development of several of the more recent reconciliation packages that Ryan highlighted in his presentation. The the uh, the work here in the One Big Beautiful Bill Act, it imposes tremendous changes in the renewable and energy incentive side of the tax code. So just from a top level standpoint, the legislation cuts incentives over the next decade in this space by roughly $500 billion. So there's tremendous change. Investments that have been moving forward under the terms of the Inflation Reduction Act may face significant headwinds here, depending on their ability to access some of these incentives and some of the new rules that are going to be imposed as a result of the legislation. I'll probably end my presentation at the same place that Mary did, with a focus on the prospective regulatory environment. It's going to be a big thing to watch, and so I'll get there in a minute. In thinking about the incentives under the bill and the changes under the bill for these incentives, I sort of break the energy side into three buckets. One is the just general power sector, so generating facilities, and those are sort of thought of in two major frames. There's sort of eligible qualifying facilities that include standalone storage or geothermal, nuclear, things like that. And then wind and solar. And so these two sort of areas really diverge. Wind and solar in particular have faced sort of significant changes over the last couple of decades in the first instance. As many of you remember, in the Inflation Reduction Act, there was an effort to shift from specified technologies encompassed under the production and investment tax credits to a technology neutral set of credits, 45Y and 48E, which said if you meet the general, it didn't matter which technology you were applying under, as long as you met the general framework of zero carbon emission electricity. And so we have this situation now where there are legacy projects underway under old sections 45 and 48, new projects underway under 45Y and 48E. And so and then prospective projects that are coming online under the new framework. And so if you're a project that's already in motion under 48E or 45, this bill leaves you alone. The general underlying rules continue to apply. Your safe harbor, beginning construction, and so forth. And that's if you started in 2024 and elected appropriately. If you have started in 2025 under the new framework, you have essentially 1 year from the enactment of the bill, so 1 year from July 4th, to begin construction to retain the old safe harbor rules. These safe harbor, so 1 year to begin construction under the consistent treatment that you've been operating under for the last year or so. One note there, at the turn of the year, so as December 31st, 2025, and points after, you'll start to have to face new prohibited foreign entity rules that I'll talk about in a second. And then if you start construction after July 4th, 2026, you have to place your project into service, a change of rule, flipping from begin to construction to a placed in service rule within the following year. You have to place it into service by December 31st, 2027. So there's sort of a tiered set of deadlines that you have to meet, and happy to walk through those in greater detail if anybody has any questions. For the other eligible technologies under 45Y or 48E, you have a much longer run out. You have essentially the timeframes that were set in the Inflation Reduction Act apply to the other technologies. The additional qualification being that those technologies will also have to adhere to these new prohibited foreign entity rules that will start to come into effect at the beginning of the next year. The other major bucket is manufacturing. And so manufacturing energy products, this is the section 48 or 45X, excuse me. If you've been engaged in manufacturing in the clean energy sector, 45X has been a generous subsidy. Most of those incentives continue. In fact, they added a critical mineral, metallurgical coal, to that, the exception being wind. Wind energy components badly hit under 45X. So happy to detail those questions, or even better, ask Mary. And then the third area being vehicles. If you recall, the Inflation Reduction Act created significant, and there had been precursor credits that were largely expiring that were done on a manufacturing basis. The Inflation Reduction Act moved those to per vehicle credit, and we're quite generous. Those credits are terminated as of the end of the federal fiscal year. So September 30th, those credit ends. It's both the direct credit for vehicle purchases, but also the leasing credits under 45Y. So or 45W, excuse me. And so both of those programs for automakers and dealers and so forth, people who benefited in the vehicle ecosystem, those credits are terminated at the end of September. These programs, in addition to the deadlines that I highlighted in termination periods or extensions, these programs now all face this new concept of a prohibited foreign entity. Prohibited foreign entity rules build on, for those of you who worked in the vehicle space or vehicle battery space over the last couple of years, you're familiar with what was shorthanded as FEOC, foreign entities of concern. This rule builds on the FEOC restrictions and extends them to the other technologies in a sense. A prohibited foreign entity can be thought of in two main categories. One, specified foreign entity, and this is a company that is maybe listed on our export controls, or is headquartered in China, or is listed as a company that is doing business using forced labor in Xinjiang province, or any number of particular designations that is specified in statute. So you're a specified foreign entity, or you are a foreign influenced entity. And a foreign influenced entity is an entity that has shared effective control with a specified foreign entity. So if you're a company that is producing critical minerals for the standalone storage market in the United States, and you are relying on a Chinese producer of an input, or if you have engaged in a licensing agreement there, or that is taking place along your supply chain, you could run the risk of being a foreign influence entity. And those rules affect your ability to qualify for the tax credits in the underlying programs. These rules extend to licensing agreements, and there are special rules of applicability for publicly traded companies, because it can be difficult to understand who owns shares and so forth, or debt holds debt, things like that. So there's special rules for publicly traded companies. The rules also apply new certifications, penalties for failure to share some of this information, and a 10-year statute of limitations for errors and reporting requirements under these new rules. So they extend out the window for which you might be liable for certain penalties and errors. This is a significant there's a significant set of definitions, and we anticipate a fairly robust regulatory process here, as well as a robust enforcement process here. So there's going to be lots of activity at the IRS and Treasury. It really extends, and Ryan highlighted this in his introduction, but it really extends this sort of economic concern that policymakers in the United States have throughout a really broad section of our economy and manufacturing here. Right now, it is tied to clean energy, right? We saw the FIAC rules with respect to automotive. We see this PFEs here, prohibited foreign entity rules, now across the clean energy sector. But there are similar limitations in the CHIPS Act program. So Mary highlighted the increase in 48D, the subsidies for building a chip manufacturing facility in the United States. And they build off of bipartisan interests in the National Defense Authorization Act. So I would anticipate, if I were, in this, if I were thinking about manufacturing and thinking about relationships across China, Southeast Asia, other covered nations, so it's not just China, be thinking about your supply chain vulnerabilities, because I would anticipate that these types of restrictions encroach in other tax subsidy, tax incentive areas. Thinking about this from a guidance standpoint, there are a couple other major elements here, and then I'll wrap up. But one of the key concepts in the generating side that I highlighted, sort of this ability to begin construction, that is a set of definitions that rests on what's known as sub-regulatory guidance, guidance out of the IRS about sort of what it means to begin construction. And the industry shifted to this begin construction rule because there were frequent expirations of the underlying clean energy subsidies. These cliffs sort of drove everybody crazy trying to place things in service before the end of the cliff date, while the project itself was held captive to things outside of the developer's concern. Permitting restrictions, supply chain changes, state and local authorities, access, even just access to the grid, where the grid operator, may not be on the same time frame as the developer. So the developer had done everything right and was held back by some third party restriction. It was easier to say, okay, well, as long as you have begun construction and we know this is going to be placed in service within this sort of general window, then you qualify for the credit. And so that is all done on a regulatory basis. And so now with this new focus on these questions, there are concerns in the community that these underlying rules might get shifted around. It became hotly litigated sort of in the legislative process between the House and the Senate, between these camps about sort of placed in service, beginning construction. What does that mean? What are these rules? And 3 days after the bill was enacted, the president released a new executive order calling for heightened scrutiny on all of these rules and directing Treasury to produce relevant guidance within 45 days. That date is August 18th. And so we anticipate over the next couple of weeks seeing changes to this underlying credit. So we're watching this very closely. And for those of you who are in this space, would be an extremely relevant time to get in front of folks at Treasury and the service, people in the political sphere at the White House, to sort of highlight your interest in this area and make sure that there's a path forward here, notwithstanding some of these regulatory changes. So that's a lot. I know I skimmed through that, but if there are questions, I'm always happy to dig in there. And so is the rest of our team. So thanks a lot, Rebecca. Back to you.
Thanks, David. And I see there were two questions placed in the chat. Mary answered one, and then David just addressed the executive order question. So I'm going to kick this back over to Matt Leggett, who is a partner in our public policy law group in DC, who will continue talking about some of these tax provisions. But I do think one thing that really struck me, listening to both David and Mary, is really kind of, I feel like, the dichotomy between permanent provisions and then tiered implementation and really making sense of all of that. So I think that, for me at least, listening is also a key takeaway here, is really sifting through the information and giving businesses a roadmap in terms of what's permanent, and maybe something we can think about addressing during the Q&A is really, what does permanent mean? And then in terms of the tiered implementation, just something to be thinking about, what does that look like and how do you take advantage of that? So with that, I will turn it over to Matt Leggett.
Thanks, Rebecca. I'm Matt Leggett. I am a partner in the Washington, D.C. office of K&L Gates. I lead the energy policy team here at the firm. Came to K&L Gates about 2.5 years ago after 17 years working on Capitol Hill. I was most recently the chief counsel of the Senate Energy and Natural Resources Committee. Before that, I was chief counsel of the Senate Environment and Public Works Committee. And before that, I worked in Senate Republican leadership, managing those committees and all energy, environment, natural resources issues. And so this is a very exciting time to be in energy policy, also a very daunting time. And depending on what perspective you have, it could also be a very concerning time. And so the One Big Beautiful Bill Act is one piece of a larger ecosystem of energy, environment, and natural resources policy in Washington, D.C. that is creating dramatic change, for wind and solar, as well as oil, gas, coal, geothermal, nuclear, other energy resources. So with regard to the One Big Beautiful Bill, I am going to talk about the non-tax energy provisions. I'm sure most of you have been focused on the tax provisions that David has just run through, as well as Mary on more of the corporate and business side. I'm going to talk about the non-tax business, non-tax energy provisions in the One Big Beautiful Bill, which also, to varying degrees, have a meaningful impact for New Jersey businesses and beyond. These provisions emanated from the House Energy and Commerce Committee and the House Natural Resources Committee, and on the Senate side from the Senate Energy and Natural Resources Committee and the Senate Environment and Public Works Committee. Those were the committees that had jurisdiction over non-tax provisions and that were instructed in the budget resolution that kicked off this budget reconciliation process. So the outcome of that process was, first and foremost, rescissions of unobligated balances of funding for programs at the Department of Energy and the Department of and the Environmental Protection Agency that had previously been enacted in the Inflation Reduction Act. And I will just run through a list of some of those programs that may be of interest to New Jersey businesses. Those programs include state-based home energy efficiency contractor training grants, Department of Energy loan guarantee programs, advanced technology vehicle manufacturing programs, transmission facility financing, grants to facilitate the siting of interstate electricity transmission lines, interregional and offshore wind electricity planning, modeling, and analysis, advanced industrial facilities deployment program, and out of EPA, funding for clean heavy-duty vehicles, grants to reduce air pollution at ports, the Greenhouse Gas Reduction Fund, diesel emissions reductions, funding to address air pollution, low emissions electricity program, greenhouse gas corporate reporting requirements, methane emissions and waste reduction incentive program for petroleum and natural gas systems, greenhouse gas air pollution plans and implementation grants, environmental and climate justice block grants. There are an awful lot of programs that any number of companies that are on this call may, be participating, may have hoped to participate in, that may be impacted. All unobligated balances from these programs have been rescinded, and so are no longer available for the federal government's use. I would just note that the sort of three major programs that I mentioned are the Department of Energy Loan Guarantee Programs Office. That did have $1 billion restored for use, and that money will be focused on primarily nuclear, but also critical minerals and to some extent natural gas. Two programs in that list that I mentioned were actually repealed in addition to the funding being rescinded. That was the Advanced Technology Vehicle Manufacturing Program, and also the Greenhouse Gas Reduction Fund. Now, the Greenhouse Gas Reduction Fund is the fund that where 20-some billion dollars was being held at Citibank. A lot of news about this at the beginning of the year. EPA went after that fund hard. That is the fund that provided sort of the financing to create an ecosystem of nonprofit, non-governmental organizations and sort of community banks and funding for sort of states and communities to stand up different financing mechanisms to provide support for solar, for wind, for kind of local and regional renewable energy projects. My suspicion is New Jersey had a lot of interest in that program. That program has not just been rescinded, but also repealed. Going beyond just the rescission of funds, and I would note that the reason that the other programs were not repealed, which was passed by the House of Representatives, the reason the other programs were not repealed was because the Senate parliamentarian ruled that the other programs could not be repealed under the budget reconciliation process. So a sort of procedural adjudication within the Senate to comply with Senate rules is what actually prevented those other programs from being repealed. Now, moving to some specific programmatic changes that the Inflation Reduction Act, that the One Big Beautiful Bill Act made, in addition to these rescissions of funds and repeal of two programs. One provision that cuts across the energy space and should be very meaningful for any participant in the energy space when it comes to interactions with the federal government or with federal land, including offshore New Jersey, is a provision to allow project sponsors of energy projects to pay a fee in return for expedited National Environmental Policy Act permitting reviews. So that fee can get you an environmental assessment within 180 days and an environmental impact statement within 1 year. And the fee is effectively 125% of whatever the cost is for preparing that EA or that EIS. Can be less if the project sponsor is actually the one doing the EA or the EIS. And so that will have a meaningful impact in terms of timelines. A fee can be viewed as consideration paid to the federal government in return for that expedited timeline. So it's not just a timeline in a vacuum. It's a timeline with some teeth because a fee has been paid. So that's something to pay attention to. That will be implemented further by the Council on Environmental Quality out of the Executive Office of the President. The second main provision I want to talk about is renewable energy. The bill imposes an acreage rental fee and a capacity fee on renewable energy rights of way holders, specifically for wind and solar. So whereas before wind and solar on federal lands did not have to pay an acreage fee or did not have to pay a capacity fee, it now will. That will be implemented by the Department of the Interior, and will create additional costs for wind and solar projects on federal lands. Will also bring it into alignment with other fuels that are developed on federal lands. In addition, the One Big Beautiful Bill Act establishes a revenue sharing program for renewable energy projects on federal lands. So going forward, the state of New Jersey will be entitled to 25% of revenues that are derived by the federal government from any energy production, any renewable energy production, specifically wind and solar on federal lands in New Jersey. Most likely that means offshore in the future. 25% to the state of New Jersey. In addition, 25% to counties in New Jersey that can claim some of that federal level revenue was derived from their jurisdiction. That again aligns wind and solar with oil and gas production on the Gulf of America now. At the time, it was called the Gulf of Mexico, and there's something called the GOMESA Act, the Gulf of Mexico Energy Security Act, that provided for revenue sharing on the Gulf Coast. And so those are the two primary provisions that I think New Jersey businesses will be interested in. There was also a provision that was added at the very end into the bill on artificial intelligence, providing $150 million to the Secretary of Energy to mobilize the national labs to develop artificial intelligence models and further use data to develop those new energy technologies. That may be of interest to you all. Something else that is a clear sort of commitment to the really Washington, D.C.'s bipartisan view for needing to turbocharge America's capacity to win the AI race against China. In addition, just for your awareness, and to some extent, you all may be interested in these additional provisions. The One Big Beautiful Bill Act, again, really being focused on federal lands where the federal government actually has a budgetary impact. It directs lease sales for oil and gas on onshore and offshore federal lands. It also sort of reforms many of the processes around those lease sales, including reducing royalty rates that had been increased under the Inflation Reduction Act for oil and gas. It also directs the Secretary of the Interior to issue coal leases. No one, really believed that coal was going to sort of have a path forward on federal lands in the future. Well, now we have it. The Secretary of the Interior will be issuing coal leases for development of coal on federal lands, including some additional modifications that facilitate coal production from federal lands. In addition to that, mining, some provisions to help with mining on federal lands, and then just general federal land management issues. Rescinds on this could impact New Jersey. Rescinds on obligated Inflation Reduction Act funding for the U.S. Forest Service, National Park Service, Bureau of Land Management, with Forest Service and Park Service potentially being the most likely to impact New Jersey. And to the extent you want to come to Washington, D.C. next year, or perhaps to a national park or another sort of federal facility in 2026, the bill allocated $150 million to celebrate America's 250th birthday. So there will be I think, a sustained effort over 2026 to represent, to celebrate America's birthday, certainly in Washington, D.C., but I'm sure across the United States as well. And we actually represent some fireworks producers here at K&L Gates, and they're very excited because business should be good next year for them. Lots of fireworks. So with that, I just also want to note that David mentioned the executive order, I believe, on implementing the 45Y and 48E production and investment tax credits for energy, and how that executive order is sort of focused on elevating the scrutiny for wind and solar in terms of implementation of those tax credits. That is something we have a lot of clients interested in, and we will be following very closely. And we are happy to answer questions on that front and engage with policymakers to the extent engagement is called for. In addition to that, and in addition to sort of the weighting in the non-tax provisions in favor of fossil fuels and to varying degrees adding costs to renewable fuels on federal lands, the secretary, Politico reported last night that the Secretary of the Interior is circulating an internal memo at the Department of the Interior to require that any wind or solar project that is pursued on federal lands has to be approved by the Secretary of the Interior personally, and will no longer be sort of litigated or adjudicated throughout the permitting process, at the lower career levels of the Department of the Interior, as it has been traditionally. And the reporting indicates that it's not just the final approval for the project. It's also the approval for the scoping study. It's the approval for the access road that may be needed. It's the approval for the offshore wind seismic study, for example. All of those approvals will require the Secretary's personal sign-off. That will be, if that is true, if the reporting is accurate, and if the Department of the Interior actually follows through with that memo, that will be a significant impact on the ability to actually move through the permitting process for wind and solar, including offshore wind projects. And so we just put that on your radar. That is another thing we'll be watching very closely, and we will, I'm sure, be engaging with clients on. We do have clients in the wind space, both offshore and onshore, as well as in the solar space and otherwise. So they will be very interested. We'll be working very hard with them on that. There are lots of other developments. There are just too many to talk to in this time frame. But we are happy to serve as a resource and try to help you with your questions and engagement in Washington, D.C. generally.
Matt, I see there were some questions in the chat, but David and Mary have been answering them. So to those in the audience, if you do have a specific question, we are monitoring the chat. To the extent we potentially, will respond in the chat. Everyone should check that out. And to Matt's point, in terms of resources, I also dropped in the chat, in addition to email addresses when my colleagues are speaking, some landing pages on our website where our team has been monitoring everything in real time in DC. You can go to that landing page if you want, subscribe to our email list, and then get constant updates. We're going to switch gears in a moment, but before we do, listening to Matt talk, Matt, is New Jersey and Virginia is the other state, have our off-year gubernatorial elections. So no matter what, because our current governor is term limited, we are going to have a new governor in November, and we're also working on our energy master plan. So it also seems to me, and I don't know if you could quickly comment upon this, in terms of the One Big Beautiful Bill and some of the federal energy provisions and what that may mean for the states. To what extent, and if you can't answer this now, I'm just thinking this off the top of my head, but do you think states need to pay attention to these provisions as they're coming up with their own energy plans to guide, potentially state wind, state solar, state nuclear?
Yeah, that's a great question, Rebecca. I think that there are varying layers of what states should care about in this bill. I mean, one obvious one that I mentioned is the state-based home energy efficiency contractor training grants program. That very well could be a popular program in New Jersey, and the state could care about that. The Department of Energy Loan Programs Office had become a pretty powerful financing tool, including for states. There was a state component of the Section 1703 Clean Energy Financing Program that now is no longer available in terms. It's available as a program, but not available in terms of any credit subsidy appropriations. That were appropriated under the Inflation Reduction Act. There actually may be a little bit of credit subsidy left pre-IRA, but that's a question I would have to look into. Just another, the Greenhouse Gas Reduction Fund is a fund that was going to allow sort of states and localities to stand up their own financing mechanisms, along with sort of non-governmental organizations, and that tool has not only been rescinded but repealed. So to the extent the state was planning on that program being available going forward, it's going to have to reassess in its energy plan what that means for it. There are other sort of things, like a lot of the EPA programs often run through the states, like diesel emissions reduction grants or funding for clean heavy duty vehicles or grants to reduce air pollution at ports. A lot of that funding ends up running through state implemented programs. And so, to the extent that the state was, expecting funding that it had not yet received, it's going to probably have to revise its plans on that front. I would also just note on this question that the Congress is currently pursuing a regular appropriations bill right now, which is separate from the budget reconciliation appropriations bill that was just enacted. One of the proposals in that bill is to repeal $4 billion or to redirect $4 billion in funding to electric vehicle charging infrastructure that had been provided under the bipartisan infrastructure law, the Infrastructure Investment and Jobs Act, which preceded the Inflation Reduction Act in the same Congress, redirecting $4 billion for energy charging infrastructure to other priorities at the Department of Transportation. I believe they're actually proposing to redirect a lot of it to the Federal Aviation Administration to address all the problems there. But that money is money that is distributed through the state departments of transportation, and there is litigation around whether the federal government can sort of stop distribution of that money to the states because it's sort of is channeled through formula funding, which is different than non-formula funding, and oftentimes give the states a lot more protection to actually receive that money and a lot less ability for the federal government to manipulate it once it's been enacted. But there are lots of questions in terms of state funding that states have been planning on in their long-term energy plans.
Thanks, Matt. So it seems like, just for everyone here, it is a good time. I know we all feel like we're balancing so many things and there's so many changes at the federal level, a lot of uncertainty, I think, here in New Jersey too, but it does seem like it is a good time to figure out potentially how to take advantage of some of this uncertainty and figure out how the two can work together. So I do want to be mindful of time. I know there is the 10 o'clock manufacturing group call that a lot of people are going to be going to. I want to switch gears now. We're going to move to healthcare, where we're going to have Victoria Hamsho, who's an associate in our public policy and law group in DC, does a lot of work with healthcare clients, who will talk for about 10 minutes to give us an overview of some of the healthcare provisions that we all need to be paying attention to. And then we should have time at the end, just for everyone to get together, have one basic question, but I know we've been doing Q&A throughout. So Victoria, the floor is yours.
Thank you so much, Rebecca, and thank you everybody for having us. So even though the Big Beautiful Bill Act is primarily focused at advancing tax, energy, border security, and other priorities, it does make substantial changes to healthcare, mostly as a means to offset some of those priorities, which have been estimated at anywhere from 4 trillion over a decade or above. With regard to healthcare, the bill makes substantial changes to Medicaid and Medicare. It has been estimated to reduce federal healthcare spending by around 1 trillion over 10 years, and has been estimated to potentially result in over 11 million people losing health insurance as a result of changes to Medicaid and the Affordable Care Act. I note these two things mostly to emphasize that it doesn't matter, political affiliation that will result in dramatic changes to the healthcare industry as a whole. And this is that if you're in the healthcare industry, no matter your role, you should be watching, you should be analyzing how it could impact you and your business, and potentially consider engaging in. And so let's start with the Affordable Care Act. I think when it comes to the Affordable Care Act, one of the most interesting things about this bill is actually what it omits. Despite significant outreach by numerous stakeholder groups, from anywhere from business to consumer groups to provider groups, the bill fails to extend the Affordable Care Act enhanced premium tax credits, which were created under the American Rescue Plan Act and later on extended until the end of 2025 under the Inflation Reduction Act. Not extending the enhanced premium tax credit has been estimated alone to result in over 4 million people potentially losing insurance by 2034. Again, this is something that numerous groups were very active on when this bill was being drafted, and in advocating for inclusion potentially as part of this vehicle. But at least looking ahead, again, this is something that expires until the end of 2025. So it's something that people are still active on and considering other potential vehicles, whether it's through an end of year appropriations package, whether it's a potential second reconciliation bill, or another potential healthcare vehicle. And so I did want to highlight that this is something that was not included in the bill. As Ryan mentioned at the beginning, one thing that was included, not just with respect to the Affordable Care Act, but also with Medicare and Medicaid, is restrictions on eligibility. And this is something that would impact certain immigrant groups, particularly asylees, refugees, people with temporary protection status. And really what the provisions we're doing is making sure that the premium tax credits, Medicare, Medicaid, and these programs were available to U.S. citizens, lawful permanent residents, or green card holders, as well as certain immigrants from Cuba and Compact of Free Association migrants residing in the U.S. And so this is a theme that the bill has in both changes to the Affordable Care Act, Medicare, and Medicaid. The one thing that the bill also does with the Affordable Care Act is it has provisions aimed at addressing waste, fraud, and abuse. It does have provisions strengthening verification requirements for enrollment, also just mechanisms for special enrollment periods where there tends to be a little bit more fraud, and also removing certain caps on the ability of the IRS to recapture improper payments. With regards to Medicare, like I said, it does contain certain restrictions on eligibility. But one thing that is significant on the Medicare space is one thing that it includes and one thing that omits. So one thing that it includes and was included in the final version of the bill, so something that was added towards the final package, was what's known as the doc fix. The bill would authorize a 2.5% adjustment to the Medicare physician fee schedule payment rate for 2026. This is something that if you're in the industry, Congress has to deal with every year. And so it's normally done through an extenders package at the end of the year. And just given the way the appropriation cycle has worked for the past year, people were hoping to include this as part of this measure, and it was included. The one thing that was included in one of the first versions of the bill that passed the House of Representatives, but that didn't make its way to the final version of the bill, was also a delay of the scheduled 8 billion reductions in payments for Medicaid disproportionate share hospital reductions. And so again, these are two things that are normally dealt with as part of appropriations bills at the end of the year that many industry groups were advocating on. And so I can imagine, especially a lot of the physician groups and provider groups trying to address this as part of another moving vehicle. Now, like I said, a lot of the reductions come in the Medicaid space. So in addition to the restrictions on eligibility that I touched on, one of the most significant additions in the bill is the personal accountability requirements that Ryan described at the beginning of the presentation. So the bill would require states to implement what they deem as community engagement requirements, and these are geared towards able-bodied adults without dependents. Certain groups are exempt explicitly in the legislation, and that includes individuals who are medically frail, certain individuals with physical or intellectual disabilities, certain groups of veterans, among other groups. And it also provides states with the flexibility to provide certain exemptions for short-term hardships. And this is something that, again, a lot of groups were very active on, but that will depend a lot on how different states go about implementing this. So for a lot of these groups, especially even the ones that got an exemption in the bill, they are looking forward to working with their states as to how these requirements are going to be implemented, since a lot of these definitions will vary by state and they may come with other requirements and the like. Another big change in the Medicaid sphere were reforms to what are known as certain financing practices, especially when it comes to providers and states. And a lot of the most biggest cuts in the bill came in the form of changes to provider taxes and state-directed payments. And this is important because it impacts different states differently, but especially it impacts expansion state differently than non-expansion states. And so particularly New Jersey being a Medicaid expansion state is something to look after. So the bill prohibits, for non-expansion states, they prohibit them from increasing the rate of their current provider taxes. But for expansion states like New Jersey, beginning in 2028, the bill would see the provider tax rate reduce by 0.5% per year until it reaches 3.5% in 2031. It also includes some limitations on new state-directed payments that have been submitted or in the process of being receiving approval, and also includes certain limitations. So for new programs, it provides that the payment rates must not exceed 110% of the equivalent Medicaid rate in non-expansion states and 100% of the Medicare rate in expansion states. And these things are important because, especially if you're a provider or your hospital health system, both of these programs, Medicare and Medicaid, are known to reimburse consistently below the actual cost of providing care. And so changes to these mechanisms by which states and providers are able to service their population can cause big disruptions in their systems. And it's something that providers have to work with, especially with their states, as these changes are being implemented. From most of the healthcare provisions in this bill, these changes to financing mechanisms were some of the most controversial ones and the ones that caused the most advocacy, particularly from provider groups. And so one thing that was added at the end and made it through final passage as a means to ameliorate the potential impact of these provisions is the creation of what's called a Rural Transformation Fund. And so what the Rural Transformation Fund does is establish a 50 billion grant program that would be administered by the Centers for Medicare and Medicaid Services that would try to ameliorate some of that financial impact of the other changes in financing. This is important because there are some details in the bill about this program, but most of it is going to come in guidance later in the year. Applications from states are due in December 31st, 2025. And so it's important for especially provider groups, for hospitals to work with states to ensure that they submit applications and that it's something that can help your groups. And just as with the Affordable Care Act and Medicare, there are other reforms that are aimed at reducing waste and abuse in Medicaid. And so a lot of it has to do with making sure that beneficiary data is up to date, that the states review the Social Security Administration debt master file to make sure that beneficiaries, providers, and suppliers are alive, and that there's no improper payments being made. The one thing that was an investment, so a lot of these are things that would save money for the government in order to offset some of the cost of the bill. I would say some of the things that were additions to the bill that would be investments have to do with means to enhance choice for patients, particularly when it comes to health insurance. And so one big win in the bill for business groups was that the bill makes some of the COVID CARES Act telehealth safe harbors for telehealth permanent. And so it's something that would allow telehealth for health savings accounts, that would allow telehealth without a deductible. This is something that business groups had been advocating for the past several years. And so it was a win for their community. And there's also certain investments with regards to health savings account more generally that and in the way to use health savings accounts for certain arrangements like direct primary care arrangements, for instance. And so that is something that was included in the bill. The only thing that I would note, because I touched on it earlier, is what didn't actually make it to the bill. So I noted the House version of the bill included a delay of the Medicaid disproportionate share hospital reductions. That was something that was initially included, but that didn't make it to the end of the bill. Other things that were in the original version of the bill that passed the House, but that did not make it to final passage, were with regard to prescription drug pricing and mostly pharmacy benefit manager reforms. So the bill that made it through the House had some provisions aimed at increasing transparency on pharmacy benefit manager transactions, and it would have required PBMs, especially in the Medicare Part D space, to share information with their plan sponsors about their business practices and formularies and the like. And it would have also included ways to ensure that they're more transparent about their coverage decisions and how they impact affiliated pharmacies. And so this is something that there's been numerous bills addressing PBM practices introduced in Congress. In the healthcare industry, many were watching as to whether or not this were going to be included as part of this vehicle. They were not, but I know there continues to be interest in advancing perhaps even a standalone PBM bill in the next couple of months. So that is something, an area to watch. And the other thing I would note, because I want to be mindful of time, is what to expect next. One thing when it came to negotiations on Medicaid in this bill was what became the Rick Scott Amendment. And so Florida Senator Rick Scott introduced an amendment that was ultimately not voted on, but that was very part of the negotiations that were unfolding, that would have rolled back Medicaid expansion. As you can imagine, this was very controversial because it would have reduced spending by another $300 billion over 10 years, on top of all the other changes. And so this is something that was ultimately not considered, not voted on, and not included. But we understand, especially from remarks that have been made after the passage of this bill, that this is something that could be in play as part of a second reconciliation package or as part of another legislative vehicle. And so I would say that is another area to watch. Changes to Medicaid are not over. And so if any of these things impact you or you want to be engaged, this is the time to do so. Thank you.
Thanks, Victoria. And I can see we're just about at the top of the hour, but I think Victoria really summed that up best with all of these different topics. That changes are not necessarily over. I think this is the beginning, not necessarily the end. We're definitely here after the program. You have all of our contact information in the chat. When in doubt, you can reach out to me. I'll get you to the right person. Happy to continue the dialogue and the conversation, because I think there are certainly going to be more changes down the pike. And this, as everyone has talked about, in many respects, this is very good for the business community. So you should all be thinking about what you can be doing now. Each of the speakers talked a little bit about what implementation may look like immediately, over the next 6 months, over the next year, and that's certainly something we'll continue to monitor. So I do want to thank all of my colleagues from DC for being here today. When Ray contacted us, I reached out to them and everyone jumped on the opportunity. I know I've learned a lot from all of you this morning. And with that, I would like to turn it back over to Ray Cantor, because I know there is the 10 a.m. manufacturing call as well.
Yes, thank you, Rebecca. It's a very busy morning for NJBIA and all our members. Two great seminars back to back. I want to thank you, Rebecca, for pulling this all together. It was really just a quick email to you, and you did the rest, and pulling together a great team to try to make some sense of a very complicated law. And obviously, we're going to have to follow, the guidance and the regulations that are coming forth from this, and also pay attention to future legislative changes in Congress. So thank you for making this all more meaningful to us. We've had a lot of requests for a recording of this. We're going to work to see if we can make that happen. I believe K&L has already consented, for its release. So pay attention. We'll either send it out or we will have it posted on our website. So again, a lot of questions were in the comments as well. I believe a link to our next seminar on manufacturing issues. So I encourage you all to log off here, log on there. And I'm going to thank again, Rebecca, K&L Gates, all the professionals who spoke today. And again, thank you very much.